We can look at data points across all of our customer activity, across macroeconomic trends, and say, here's what we predict in terms of potential cycles. Here are sectors where we believe we should double down in terms of credit extension or market activity. Here are sectors where we maybe want to be more conservative right now. So I think the predictive benefit in the lot of places that we heard from NASDAQ about, predictive benefit is huge, and we do an immense amount of modeling. I think the other place where it plays that people may not see every day is in how we manage our liquidity and our balance sheet, so that we can take advantage of or create competitive advantage around the way we manage what's on our side of the balance sheet, so that in a razor-thin margin business with interest rates notionally low, and we agree with everyone else that's a positive, but at low notional interest rates, you know, the margins that are available in banking make us envious of grocery stores. And when I was coming up in the business, the one place where it was tough to do business as a banker was in grocery stores, because the margins are razor thin. Well, we're jealous of that in banking. So how we manage every dollar that is within our system is very important, and we use technology every day to do that. We do an extensive amount of testing. We call it back testing, so we can take the technology of today, use the data of a previous cycle, and make sure that it would have accurately predicted what actually happened. So back testing helps us a lot. We're smart enough to build in the right margins of error and the right checkpoints and milestones along the way. So it is not the abandonment of human judgment into technology. It's the use of technology to create the data and the analytics to make great judgments by humans possible. I'd say Silicon Valley Fintech is its own niche industry. And 4 years ago, 5 years ago, I used to say that as a bank, Bank of America had to be a fintech company, or even would go so far as to say we were a fintech company. I've come off that a great deal, because there's a huge difference between a financial institution or a large corporation and a fintech company. We're highly regulated. We do not have any room, hence my previous discussion, we don't have any room for fail fast, fail big, fail often. You know, the innovations that we do have to come to market in a reasonable, high likelihood of success. And there are lots of other, you know, we have to report quarterly earnings. We've got, we don't have patient venture capital or even impatient venture capital that comprises our balance sheet. We have, you know, 10 billion shares outstanding. So that doesn't mean, though, that we don't have to be innovative. And so we do two things. We create this notion where innovation is everyone's job. And you can say, oh, haha, that's funny. It's, you know, that means it's no one's job. But in reality, we generate an immense amount of intellectual property. We're the financial institution with the most patents, highest ranking on the U.S. Patent Office list. So we do prove out with 4,500 or something inventors that we have a capability to make innovation everyone's job. We also create pockets in the firm whose job is to either innovate themselves or to find emerging technology firms, so that we can create that thin slice that you suggest. We have the scale to do it both. We do business with a lot of fintech firms, and you would find that when we do find that secret sauce, our scale and capital can put a small fintech company that otherwise might have VC money but not a world stage for delivery of their capabilities. We have the opportunity for them to have a world stage.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.